Hey guys, welcome back to another week of Mortgage Matters in Minutes. I'm your host, Brent Rasmussen, and this week we are going to cover which loan is right for me, fixed or adjustable rates. So that's a common discussion we've been having here in the last 3 to 6 months. And the reason why it's a common discussion is because this year alone we've seen interest rates increase by as much as 3%. And what happens is when rates increase, people are trying to work to find a more affordable way to purchase their home or to have a more affordable payment. And the reason is because adjustable rates obviously come with a lower interest rate compared to fixed rates. And why is that? Because the risk is higher on the adjustable rates. So because of that risk, they have to give you some kind of a reward. So let's first talk about what fixed rate loans are. Obviously, fixed are the simplest, meaning the rate will never change over the time frame. Whether that's 5 years, 10 years, 20 years, 30 years, that interest rate is same throughout that entire time frame. So while your principal and interest will never adjust, your taxes and insurance could increase and your payment still could go up, but your interest rate will still stay exactly the same. So that is obviously the most conservative way of handling things when taking out a loan. But as we've seen interest rates creep up from the 2s and 3s to the 5s and 6s, and home prices have nearly stayed the same, the payments obviously have gone up drastically for people. So they're looking for ways now to say, how can I make my payment much more affordable without taking out a fixed rate loan? And there is adjustable rate loans. I would say here at Mortgage Specialists, we generally haven't spoken with clients much about adjustable rate loans over the last 10 years because rates have continually come down and there hasn't really made sense for people to take out an adjustable rate. But now might make sense because what we've anticipated and are possibly seeing is that here in the next year or so, rates might come back down. Anytime we've had a recession, interest rates have lowered. And so many people now are wanting to know, hey, is it a good time to take an adjustable rate mortgage? And it might be. Adjustable rate mortgage basically is a loan that the interest rate can change throughout time. Sometimes that loan is fixed for a year. Sometimes that rate is fixed for 3, 5, 7, 10 years. So an adjustable rate is always going to give you a fixed time frame. After that fixed time frame, your rate can adjust, and it can adjust every month. It can adjust every 6 months. It might adjust every 12 months. And the formula to calculate what your rate is a specific index plus a specific margin will give you your interest rate. So maybe the index happens to be the prime rate, or happens to be how I describe it as maybe it's the price of gasoline plus 2% is your interest rate. Or maybe it's the price of some particular index or stock price. Whatever it is, generally it's going to be off of a prime interest rate plus a margin of 1 to 3% gives you your particular rate. So what we want to look at is, does the risk in the future offseed the reward? And many times it does, many times it doesn't. A lot of first-time home buyers look towards adjustable rate mortgages because they might not be in their house very long. Where maybe an individual that's building their final house and they have a loan over 30 years, they might not want to take on that risk because of what markets could do in the future. So adjustable rates obviously are good. They're not always bad. A lot of people assume that all adjustable rates are bad, but it has to work at a specific time frame and the best time frame for a consumer. And the best time frame is obviously vacating that loan before it adjusts. And what we've seen in the past, so we look back for years of history, people took out adjustable rate loans anticipating they could refinance or sell that house. And then the markets changed again and rates went up and they were stuck with that adjustable rate mortgage. So that is the risk there, is that if you're not able to get out of that loan before rates get better, you might be stuck with a much higher rate than you even started with. Or we've seen this in the past where rates actually got better and the adjustable rate loan got better in compared to what the market was. So is there always an easy answer? Is a fixed rate loan better than an adjustable rate loan? No. Every market is going to be different. Every consumer is going to look at the fixed versus the adjustable rate. These are the conversations that we have every day to go through all the pros and the cons of the decisions that are best for you, to explain all options so that you are aware when you want to look for a home, what is the best option now, 5 years, 10 years, 30 years down the road, and what are your best financial choices to make the best decisions for you. We're here to help answer any questions, obviously, at Mortgage Specialists. We have many blogs on our website at mtg-specialist.com. We're always just a phone call away at 402-991-5153. And a reminder, we're not always here just 9 to 5. We're always working evenings, weekends, and here to answer any questions day or night. Hope you have a great week. We'll talk to you again next week, and make it a great day. Mortgage Specialists. Driven, trusted, reliable.